Hello friends, good morning one and all. Welcome to my new video on business fundamentals. In this video, we are going to discuss about some of the basic concepts of accounting. What is accounting? Many people, many business people afraid of accounts. Why? It involves numbers. People are afraid of numbers. Since childhood, we are afraid. I too afraid of maths. So accounting is nothing but what is the business, how it runs money. Money is involved. Whenever you sell or buy a product or buy a raw material, there is an exchange of money. So if you know the basics of accounting, then it will be easy for you to become an expert in your business and a successful businessman. Let us discuss accounting in some simple basic terms and examples. You have heard about terms like debit, credit, and bookkeeping, double entry system, balance sheet, profit and loss. These are all the terms which are accounting terms. These are looks like Greek and Latin for many business entrepreneurs. But actually, what is the thing is, if you just learn the basics, then it will be very easy for you to read your balance sheet, your profit and loss, and your business financials statements. Even though you hire a chartered accountant or any financial expert, you should know the basics before you are hiring. Ultimately, it is your business. You have to look after all those things. So first, we start with debit and credit. What is debit and credit? In simple terms, what a debit actually means and what actually credit means. For example, take an example of a food business. In food business, you purchase raw materials, and process them and make into some food items. Raw materials like wheat, rice, oil, and other pulses, etc., to make food items like whatever you sell. Food items like rice, curries, chutneys, etc. That means the process involves, these are the raw materials and these are the finished goods. For purchase of raw material, you go to market and you purchase it from kirana shop. It may be wholesale kirana shop. For example, you need a raw materials which cost around 1000 rupees. And after purchasing these raw materials, you sold that items, and the final amount you get at the end of the day is 1500 rupees. So this is the amount that goes out from your business. This is the amount at the start of the business, at the start of the day or the beginning. You have spent 1000 rupees for purchase of raw materials, which goes out of business, out of your account or out of your pocket, and at the end of the day you will receive 1500 into your pocket or into your counter, into your business. or into your account, whatever it may be. So this is going out, this is coming in. The money which goes out, the money which goes out is called debit balance, and the money which comes in is called credit. This is a technical terms. You need not worry about these things, but the basic term is outward money, inward money. The money goes out, the money comes in. The money goes out is called debit. For example, you see debit card. You have a debit card. That means an account with an amount in your account. If you swipe your debit card, what happens? Your account balance is reduced. The amount goes out to others. That means you went to a kirana shop and purchased these items and you pay with your debit card. And what happens? The debit card balance reduced 1,000 rupees. Your account balance reduced 1,000 rupees, and the shopkeeper's account increased to 1,000 rupees. That is his credit balance, shopkeepers. But at the end of the day, you receive 1,500 rupees by the sale of these goods. Your incoming, that means your account is credited. Credit means positive balance. So this is called debit and credit. So the basic terms, the money that goes out is debited from your account, and the money that comes in into your account is credited to your account. Then comes in business accounting, there are so many entries. You maintain those entries in the form of books. Earlier we used to have physical books, accounting books they called, but nowadays softwares have come. Very easy to maintain business accounts books. You just input the entries in the corresponding fields. Everything will be done by the computer or software. So there is no need to worry, but which entry you have to put, that is very important. In double entry bookkeeping, that means accounts, in the books of accounts you maintain, or your chartered accountant maintain, there are two columns actually. The columns are called expenses or expense. And what are the expenses in business? Whatever you spend in the beginning, that means raw material, you hire a person, for example a helper, that salary for that person, you have hired a helper. And electricity or power, electricity is consumed every day, that is also an expense. Water bill. If you are running in a rented premises, then rent, all these comes under expenses. Every month or every day, these are the expenses you have to incur in your business. So these are the expenses. And what is the income part? What is the income that you will get? You produce from the raw materials you work out, sell, and you will get the final product. That means sales. Income is from sales of your product. Your product is sold, your product is sold for a price, and that sales amount is called the income. So these are the expenses and income part, and if the income is greater than the expense, then it is called profit. Your business is in profit. And if it is reversed, then it is called loss. Your business is in loss. If income is less than the expense, then it is in your business is in loss. So these income and expense, these put together is called a statement reflecting income and expense is called P&L statement, which is called profit and loss statement, which have income and expense. The income is the what you get and expense is what you spend. Another financial statement apart from profit and loss is balance sheet. This balance sheet is nothing but your liabilities. Your business has liabilities as well as assets. These two put together is called balance sheet, the statement showing the liabilities as well as your assets. Business, what are the liabilities? Liabilities is nothing but what you have to pay, what you are liable to others. Just like suppose in the beginning video I have told you don't have enough money, you lend it from friends. So that means loans from friends, relatives, banks, etc. These are comes under liability. And also capital. What is capital? It is a owner's share. It is a liability. In company, the owner has to be paid back. It is a liability to the company. So owner's capital is also a liability. And what other comes? Capital, loans. And what are the assets? What assets are which company owns? The ownership. The company is the owns, has some assets. That means a liquid, that means cash. Company has cash and bank balance, bank account, bank balance. It is called current asset. And fixed assets. Some fixed assets like machinery, plant and machinery, building, etc. So these simply put together is balanced. The total of assets equal to total of liabilities, and it is called the balance sheet. If you look at the financial statements at the end of the financial year, every company will produce balance sheet and profit and loss publish in the public domain. Shareholders, the performance is assessed through these financial statements, and it can be compared with the previous year's figures. Suppose profit now is 10 lakhs, previously it is 9 lakhs or 15 lakhs. We can compare the business, and also we can compare with other competitors using these financial statements. So my dear friends, I think you understood the simple basic. I have explained it very simply. There is a lot of things involved in accounting, but the basics are very important. So by learning basics you can improve slowly and slowly your knowledge in accounting. My dear friends, please subscribe my channel, like and share my video so that it will be benefited for people like you, business people, so that I can give more such information, useful information in the future. Thanks for watching. All the best.